Well, price swings in the Treasury market are approaching the smallest levels in 4 years, which may signal QE2 won't cause that sell-off in government debt. Or is it a false read? James Caron is the global head of interest rate strategy at Morgan Stanley. He joins us now live right here on InBusiness. Welcome to the show. You've recently turned neutral from bearish on bonds. Is this a least dirty shirt situation, to paraphrase Bill Gross?
Well, you know, what I think is happening in the market right now is that we're seeing a consistent downgrade in growth and growth expectations. And the bond market's leading the way. I mean, when you compare that to to what equities are doing and what have you, I think bonds are actually showing that they're turning a more skeptical eye towards growth, and as a result, they're bringing down yields and growth expectations alike.
And then we see a day like today where Greece, we're reminded, is still, they haven't fully resolved their indebtedness, and people start once again looking at treasuries as a safe haven. How much is that skewing things?
Well, what we at Morgan Stanley are telling clients is that the situation in Europe is a very, very fluid situation. It's very hard to get sometimes even the most accurate information on the timeliest basis, but it's going to be an ongoing problem. That's just something that the markets have gotten used to. It's something that's already in the price. So what I would argue right now is really it's just day by day. We're going to look at Europe and we're going to look for the new developments. We're all very familiar with the situations, with the sovereign risks and what have you. But right now, what I think the U.S. bond market is focusing on, U.S. Treasuries, it's mainly focusing on the growth outlook in the U.S.
And that growth outlook here in the U.S., you say, is still not bright enough for you to heighten the expectations for an interest rate move.
Well, that's right. And really what it is it's relative to expectations. So most consensus forecasters have 4% growth, around 4% growth in the second half of 2011. What the bond market's saying in terms of what's in the price is that that's very optimistic. The bond market's actually discounting for a weaker growth trajectory. They're looking at the first quarter. The first quarter was a big miss. The second quarter, we have expected for growth around 3.3%. And what most forecasters have really done is they've pushed their best expectations for growth into the second half. And what the market's doing is day by day is it's looking at the data points and it's trying to figure out if that second half growth is really going to manifest. And so far what the markets are telling us is that it's becoming less and less likely.
And yet we have two potential events that could cause some concern once again. One is the end of QE2. The other is this debt ceiling. We're going to hit that credit limit just this week. May run out of cash by August, according to the Treasury Secretary. Are we going to see the near-term sort of panic creep in there?
Well, so far that's not what's happening, right? We're all very well versed on the debt ceiling issues, and yields continue to decline. I think that most investors see that the government is going to make timely payment on their interest and their debt obligations. There's no specific order in which they have to make their obligations, but I would argue that making good on their obligations to the bondholders would probably be the primary one. As far as the end of QE2 goes, and that would be the second area of concern. And yes, I mean, I do think that removes some stimulus in the economy, but overall, I think what the main driving factor, and I can't underscore it enough, is really what the growth conditions are going into the end of the second quarter. If growth is good and expectations are solid, then yes, yields can rise. But I don't think that there's going to be a big sell-off in the Treasury market on July 1st, just because that's the last day. June 30th is the last day that the Fed buys Treasuries.
You're a believer that fundamentals are going to trump the biggest buyer of debt from really skewing things by stopping those purchases. Well, what do you make of S&P out there warning that the credit quality of the United States is going to be on the decline? I mean, it doesn't seem like the market's convinced of that, but it was enough to send us for, a bit of panic when that headline crossed a few weeks back.
Yeah, no, that's absolutely true, and you're going to get headlines like that. I mean, there's no question, and particularly whenever we talk about the debt ceiling. But I don't think that story holds a lot of water. It's really more of a warning. And when you look at the debt to GDP levels of the U.S., it's not where it used to be, but it's still within the realm of AAA rated nations. And let's not forget, let's look at the overall GDP of the United States and let's look at how quickly the U.S. can turn a slow period of growth into a stronger period of growth. growth, and that's where the real income gains actually come, and how the debt and how the U.S. can actually service its own debt. It can actually service its own debt very, very well, and I think these are all the factors that we need to consider whenever we start to think about downgrades to the U.S. Treasuries and what have you. I think we're very, very far away from that.
And you're not forecasting any headlines out of these meetings with China, the country to which we are most indebted?
No, I don't think so. I mean, I think there's, China is the largest foreign holder of U.S. Treasuries. I think we both have mutual interests in seeing the U.S. Treasury market, be well and stable.
All right. Thank you so much, James. Interesting call. We'll see how it plays out.